Alright, how's everybody doing today? Welcome back to the channel. In this video, I'm going to be talking about how to invest in the stock market as a beginner or when you're first starting out. Now, if you're watching this video, you're most likely somewhat new to the stock market. Now, I'm going to be giving you every single thing that I personally do when I invest in stocks. Now, I have basically a list of like 15 things I do, around that much, when I personally look before I purchase a stock. Right now, hopefully I can break this down pretty simply. So what I personally have been doing is I basically pick stocks that are either undervalued or I see massive growth potential ahead of them, and I never purchase stocks that I'm probably going to be selling in a month or two. I always buy stocks with the intentions of holding them for at least 6 months, upwards of about 3 years is how far I usually look out before buying a stock. So hopefully all of this helps. Now, right before we jump into it, if you haven't already, make sure to sign up for Webull. Now, if you don't have a brokerage yet, I would definitely recommend you guys sign up for Webull. Basically, if you do that, you'll get 4 free stocks just for signing up. It's either 2 or 4, but right now, at the time of recording this, you can get 4 free stocks. All you have to do is deposit $100, and it's a great brokerage, and you'll get a great return on your money right off the bat just by doing it. So I'll have a link down in my description. Make sure to do that if you haven't already. So we're looking at the S&P, right? Within 2020, the S&P is up roughly like 14% or so, which is actually pretty good. And we can usually see the S&P go up around 8% a year on average. That's like the historical average. But by picking stocks, hopefully you guys can get a much greater gain than that. I usually try to get at least a 20% a year. In 2020, I was up triple digits. Like I was up over 100% in 2020. So hopefully I could not necessarily keep that up because that's a very unrealistic goal to have, but anywhere in the 20% range a year is usually a goal of mine at least. So first thing that I usually do when finding stocks is I look at like the business model. Right now, you guys may be thinking, where do I actually look to find these stocks? Right, like are these random stocks, or do I just go through the S&P and find random ones? Now, there's a few ways I do it. I personally sometimes just go on YouTube and just see what other like stock market channels are doing. Maybe even my channel. You guys might be watching my channel. I post stocks like randomly that I find that are good, or like other channels that personally post they're great stocks. Maybe they do like top 5 stocks. So I go through a ton of them, right? And if one catches my eye, then I actually decide to look into it more. You can also use like sometimes I just use Yahoo Finance or like the top movers of the day. Sometimes if stock goes down a lot, I might check it out. But other than that, I usually have a watch list of very good stocks that when they do fall, I usually am ready to purchase them. So the first thing I do is, we're gonna use Apple stock as like an example, is I first you gotta fully look at the business model, right? So we have Apple, for example. Now, before anything else, don't look at these statistics and stuff like that. The first thing you want to do is look at the actual business model. How are they making the money? How are they like bringing in sales, stuff like that? And how good is it? Is it a company that just selling from one store and they don't have an online business, stuff like that? Or are they a company that's doing great numbers? They're like diversified pretty well in a few sectors. So like Apple stock, for example, we know that like half of their sales come from the iPhone, but then they have services, which is growing massively. Now, this is a little outdated. I think their services is way more, but this is just an example. I'm not saying Apple is good or not. The Macs are obviously 10%, stuff like that, iPads, and they actually have stores and like they sell with their margins, stuff like that. So you guys want to know the business model, how they're actually operating and basically running their business. Is it a good business at the end of the day? Is the fundamentals there good? If it's a company that's absolutely like not having any sales and their business model is just reliant on getting lucky if something goes right, maybe it's a pharmaceutical or something, I don't know. Usually I stay away from those. I want to know that the business is doing good right now. I usually, for the most part, invest in companies that have over $1 billion in market cap. Like if the company's under $1 billion in market cap, they're usually a penny stock, and I usually don't really look at those just because there's way too much risk involved and they aren't like fully established there. The next thing I do is obviously look at like the earnings and stuff like that, their reports. So if you go to like any stock, right, you just search investor relations at the end of any company or any stock you want to research, and like everything will come up that you want to see. And what I do is I usually like read the 10Ks and stuff like that just to get an idea of like how well they're doing and stuff like that. Apple's is like right here on their like filings, SEC filings. Now, the way I do this is you're not gonna know what you're doing when you first do this. So you want to slowly learn, like it takes time, right? So even me, after like doing this for about a few years now, I still don't know exactly how everything works. So you always have to research like what everything means, how good it is, stuff like that, until you can actually get an idea. And at the end, in a few years' time, you're always going to get better, right? Maybe in a few months, you're going to get a lot better, but eventually you're going to know what the balance sheet is and stuff like that, how much money or how much cash you should have on hand in comparison to how much money you're making or how much money you're burning, stuff like that. But that's what I do. And then next, you want to listen to the latest earnings call. You want to know how well they did. Now, you can usually just find it on their thing, or if you can't find it on their website, you can just go on YouTube, like search the stock and then just type in conference call. It's usually always there. If it's not on their website, like on Apple's, you can just Google it, and it should come up if you just put Q4, Q3, whatever actual Q you're listening to at the time, what quarter. Now, after you do that, you guys might want to listen to it more than once, right? Because the first time you listen through it, you might miss a lot of stuff and you might not actually catch a lot of the important information. So at least listening to like once or twice at least is pretty decent. I would recommend it. Next, you want to actually research, like, does this company have a good like business in terms of competition? Do you think competition will in 2 years time completely destroy the stock? Like, for example, you would say Apple stock has Samsung, right? Samsung is a big one that, oh, maybe these Samsungs are going to completely destroy Apple in 2 years. No one's going to use Apple anymore. Everyone's going to buy Samsung. If you think that, if that's your consensus at the end of researching like a company, then I would probably stay away from that company. Or let's say 2 years ago, like Tesla, their competition for electric cars were non-existent. Like, you would say, okay, there's almost no competition for the stock. So I would probably stay more, or be more compelled to actually buy Tesla, because I don't see any competition in sight. So I would more focus on if the company can achieve what they're doing rather than the competition and like the risk factors and stuff like that. Another like risk factor that's not necessarily competition is if they're burning money like crazy, if they're losing money like crazy, and if you check their balance sheet and it's almost depleted, I would probably stay away, because that company could be in the risk of bankruptcy if they're not pulling a profit and they're burning cash like crazy. But you always have to remember that a company could raise money, like Tesla back in the day. Elon Musk, like, if you have a great CEO that's like pretty famous and it has a great track record, you could probably be in a pretty good situation where that guy can raise money like crazy, and now all of a sudden that company won't go bankrupt. Like, I believe Cheesecake Factory was a stock I made a lot of money on. A lot of people thought they would go bankrupt, but they're such a big company and such a big brand that they kept raising money easily. Like, they were never in a situation where they lost money, and we saw that stock is almost back to pre-COVID times. Like, it's pretty crazy. So that's that. The next thing I do is, now I want to preface this and say it doesn't have to tick every single box. Like, a few of these boxes it doesn't have to tick. The next one is the company with a positive net income? So what you can do is go on Apple or go to Yahoo Finance and just type in Apple or whatever stock you want, and it'll go under summary. You just click on financials, and there you will actually see if it has like basically a net income that's positive. So if you can just use this chart, as it's easier to see, you can see that the net income in blue is earnings 57 billion. So they made 57 billion in profit. So they do have a positive net income. Now, I want to preface this in saying the stock doesn't necessarily have to be like a positive net income. It can also be in a situation where the stock has like a future of being like profitable. For example, Tesla last year or 2 years ago, they were in the brinks, or in the like, they're really close to getting profitable, right? They were just small inches. They're like literally inches away from being profitable. So I would think, okay, they're not profitable right now, but I could see a future where they are profitable, and that's a very near future. If that's the case, then I would disregard this and I would still count it towards something that's positive. So if the company has a net income or is expected to have a positive income or positive earnings, after, like, they're basically a positive earnings would be their expenses minus obviously their revenue. So like all the expenses they would possibly have minus all their revenue. If that's positive, then they're good to go. Now, If it's COVID times, obviously during COVID, it could be pretty bad. But I'm saying in normal times, if they're positive net income, I would say generally it's very good, and that's what you should strive for. If they're making, let's say, 100 million, but they're negative one, like let's say 200 billion. Let's say they're negative 200 billion dollars, but they're making 100 million. That's not a good ratio. Like imagine you're spending $2, but you're only making $1 back at the end of the day. That's a little bit like iffy, if you know what I mean. So it just comes down to also common sense there. You can like spot what's good and what's bad. And next thing is the 4P under like 25? Is the 4P under 20? If it is, then that's really good. Now, in this climate, a stock like Apple, they have a 4P. You can check the 4P by going to statistics. 4P is 32. Now, 4P is basically the next 12 months expected growth compared to today's price. So, for example, if Apple continues to grow in 2021, they will have a 32 4P. That's pretty expensive right now. The thing with the 4P is please take it with a big grain of salt, because especially recently, 4Ps can go to insane heights. Now, if you can find a growth stock that has a 4PE under 25, it's pretty good. Like for example, I talked about Dropbox on this channel, and that had a 4P of under 25. That is pretty damn good. Now, if it's a growth stock growing pretty well and it has a 4P under 30, that's also pretty decent at the end of the day, and especially in this climate. If it's in the middle of like a downturn market, like if everything's down like crazy, then definitely pay attention more. The 4Ps will go down a lot with it, but that is that. But like Tesla, for example, has a 304P, which basically means their earnings are way less compared to how much the stock price is today. But what people do is they look at the next 5 years. In 5 years' time, they're going to be making so much revenue that the PE ratio would be even, right? Would be like pretty good. Would be maybe 40s, 35s. That's what people are really hoping on or banking on when you're looking at 5 years out, stuff like that. The next thing, has the revenue grown? Now, this is pretty important. If you're buying a company and their revenues are going down 5 years in a row, if their revenues are straight down in the last 5 years, dude, is the revenues gonna magically grow next year? Is the company magically gonna grow even though it's down 5 years in a row? Probably not. So let's look at like Apple, for example. Look at this. Since 2017, they've grown almost every single year, right? Like they've grown revenues pretty decently. Now, from 2018 to 2019, they dipped a little bit, but for the most part, they're pretty decent. And then I believe even like quarter by quarter this year, they're growing pretty well. So you would say at the end of the day, they're pretty giant in terms of bringing in massive revenues. Apple stock is, but the thing is, company the size of Apple, they make so much money that you're probably not going to see the stock revenues grow double digits. Like you're not going to see Apple grow 50% revenues next year. They're already such a massive company, and for that to happen, it's very unrealistic. But like Tesla, for example, if they grow 50% next year, that's not very far-fetched to say, right? So that's definitely something to look at. For example, let's say maybe like a dying business. I don't know. I can't really think of anything right now, but I don't know, like Hertz or something, like a rental car company that's going down, or like a hotel company that's Airbnb's taking over. If they're going down in the last 5 years, I would probably stay away. Make sure the company is growing revenues for the last few years, right? For the last 3 years at least, if they've grown consecutively in the last 3 years. Now, if their revenues dipped during COVID, I would take that with a little bit of a grain of salt, because if the revenues go down during COVID, I mean, that's pretty much expected. But check what they're doing in 2021, and like if you think they're going to be back on track, or if they're expected to go back on track, then definitely just take 2020 out of the equation for earnings and revenues and stuff like that. Next is, do you expect the company to grow net income? So like, do you think the company's earnings and profitability will grow? So like the blue earnings here, do you think that's going to grow in next year and the year after that? For example, Apple stock, like who knows, they might grow profitability. I personally think in 2021 will be a pretty solid year for Apple. Even the end of 2020 with the iPhone 12, I think it'll definitely grow profitability there. And that is that. They're already a profit giant. So this is not the best example, but like, once again, let's just go to Tesla. I'm using Apple and Tesla a lot for examples. I do think, for example, Tesla is expected to grow profitability a lot, right? Because right now they're building factories, and when you're building factories, that's bringing your profitability down. But once everything's built, you have the infrastructure, it's all profit from there, if that makes sense. So that's why stocks like that can actually be very predictable with their net income, stuff like that. Do you expect it to grow? And if it grows, it's said to say that the stock price will grow as well if it is within the like normal P ratio and stuff like that. Like if you like Tesla, yeah, they'll grow profitability, but their stock price is so high that it's almost expected that they grow for the stock price to stay the same, right? So if they don't grow what's expected, that could mean that the stock goes down quite a bit. So that is something to consider as well. So if everything here is checked, then you're good. The last few things that I usually check for is, do you think that your company has more cash and investments than debt? Not do you think, do you know? Because this, you can actually check this pretty well. So do you think the company, or what am I saying think? Do you see that the company, when looking at their balance sheet, has more cash than debt? So the way you see this is you go to financials in Yahoo Finance and balance sheet, and then you go down, I believe, to assets, current assets, and cash. So Apple has 90 billion in cash. Apple has one of the best balance sheets in the whole stock market, basically. 90 billion in cash. That's a lot. Do they almost have 100 billion in cash? Now, in investments, I believe you can see more in depth in their SEC filings, but basically on Yahoo Finance, they show it's basically like a compilation of their earnings. But if you go to their balance sheet, you can see that basically their equity, their liabilities is basically everything that they owe. And if you go to their total debt, it's $112 billion in debt. But that most of it, you have to remember, at the end of the day, all that debt is probably long-term debt that they don't have to really worry about. But their net debt is 74 billion. That's after the cash. But nonetheless, they have a great amount of cash. But when you look at assets, that's their cash and investments. That's all the assets they have. Their assets are definitely more than their basically total debt, right? Their total debt is 112, but they have 140. So if they paid all their long-term debt and stuff like that, they would be in a positive. That's usually what you want to look for. You want to look at for positive assets there, and that's very important. But Apple has so much cash on hand that it's kind of like this size of a company, a lot would have to go wrong where you would have to burn all that 90 billion, if that makes sense, not to mention the other assets they have. So that's how you look at the balance sheet. Obviously you can always learn more, like look at you can look at their inventory, obviously, all these things. You're not gonna look in 1 month, you're not gonna be able to learn everything. You're not going to be a master looking at balance sheets in a week or a month. But if you do this slowly, if you dip your feet slowly, buy these stocks, that's how you can actually learn pretty well. And I would personally not, like, if you're a beginner, don't just go out buying, I don't know, maybe like a Zoom or an Airbnb or something like that, where it's very hard to value those kind of stocks, where you can't just buy Zoom thinking, oh, it's going to go up like crazy, because they have so many things going on for them. There's so many different things that can go right, so many things that can go wrong. It's very hard to like value those kind of companies. But maybe, let's say, maybe like a Walgreens or something, where it's a very stable company. It's a very stable company. Maybe like Johnson and Johnson's like the staple of the stock market. It's very easy to value that kind of company, and if it goes down a certain point, you know it's a buy for that type of company. So you usually want to start with those simple type of stocks when you're starting off. But obviously, if you see a very good growth company that you personally think will do well after looking at all of this, go ahead, go for it. And as you like have more money to invest, hopefully you can learn more. So if you have a little money to invest now, that's actually kind of perfect, because as you get more money to invest, you're going to learn more and more. You're going to get more confident picking stocks. Now, we're basically done here, but a few more things I look at is, does the CEO have a track record? Now, this is a very important thing that I look at. For example, Tesla, which is a big one of mine, Elon Musk definitely had a very good track record of like either raising money. He like literally founded PayPal. Like, he has a very good track record, right? And he's like one of the big people in business. He obviously launched SpaceX even before Tesla, so he had a lot of things going for him. He does have a good track record, and something I especially look at is the founder also the CEO of a company. If the founder is also a CEO, when you say founder, it could also be very early on. Like I believe Tim Cook isn't the founder, but he's been with Apple since the 90s, I believe, like early 2000s to 90s. So he's been with Apple forever. He's basically a founder, right? Like he's been around even before iPhone. So you can say he basically knows the company inside and out, right? That's how you know he's good. Go ahead and research interviews. You can look at interviews with Tim Cook talking, or with yours. Not, I'm just using him as an example, obviously, but with your company, your stock CEO talking. Next, does the company return money to shareholders? Now, this is a plus, but most like growth companies don't have this. Like Tesla doesn't have this, and a lot of other growth companies don't have this. But basically, you can see their dividend yield. Dividend yield is 6.6%. Basically means that if you put $100 in Apple, you'll get what is that, like less than $1? You get like 65 cents back a year, I believe. Yeah, like you get like $1 if you buy if you buy one share of Apple, you're probably gonna get like $1 back. Or here it says 82 cents. So if it does return a dividend, that's a plus. But usually I don't really care too much if it returns a dividend. I actually prefer they don't. If it's a company that's just starting and growing like crazy, like an Amazon, probably you don't need a forward dividend yield, because those stocks are growing so crazy that there's more upside in the stock price. Like you look at the yearly chart, there's way more upside in the stock price than a lousy 0.6% gain, right? Just today it's up almost 2%, 3% after hours. So that gain is nothing, it's irrelevant. So that's just that's a small plus there. If it does pay out a dividend, that's just an extra sweet plus there. And yeah, that is pretty much it. But the very last thing you want to look at is, are you okay with buying the stock and forgetting about it in 5 years' time? So before you buy the stock, you want to be so confident that the stock will be doing good. In 5 years' time, you think that this company's revenues will be a lot higher than they are today. Their market cap, you think, will be a lot bigger, and a very big like revenue and profit machine in 5 years. Will that happen? If you're confident that it will be growing in 5 years' time, and you're okay with losing the password for 5 years and logging back in to see that stock there, and you think for sure it's no way going to be lower than this price in 5 years, then that's a very big plus, and you should probably even buy the stock if most of these boxes I talked about got checked and you think that is good. So that is about it. That is everything I personally look for when I invest in companies. Now, make sure to subscribe to this channel, especially if you watched until the end of the video. I post a lot of like great stock videos and stuff like that. I'm trying to hit 1,000 subscribers for sure in the first half of 2021. I think I could definitely hit 1,000 subscribers within the first half of 2021. So definitely make sure to subscribe to this channel if you haven't already. Sign up for Webull down below. You get 4 free stocks just for signing up. I believe it's either 2 or 4. Depends on when you actually watch this video, but definitely do that. If you deposit $100, it's already a great return on your money, so definitely make sure to do that. But yeah, thanks for watching, and I'll see you on my next video.